Well, welcome to the session on the global economy. I sure wish that I could be with you folks down in Panama. That was the plan, but I'm actually in Florida at the moment on holiday with my family. And so thank you for agreeing to have the presentation on the global economy this way. We've made this video presentation available to you, and I just want to send my personal greetings to you. I wish that I could be there with you. The CCA conference is always a highlight for me every year, and so I'm disappointed not to be there with you in person, but I'm hoping that this is a reasonable substitute for the global economy presentation for you there. So I hope you're having a great conference, and I sure hope that this adds to the wealth of information that you're actually picking up while you were down there. I actually will be calling in for a Q&A at the end of this. I'm sure that Michael has let you know that already. So let's get on with the meat of the presentation here. Behind me you can see my slide, my title slide for this presentation, the surge, the squeeze, and the solutions. And each of these things is very relevant to the construction industry in Canada, whether it's actually operating domestically inside of the country or whether it's on the export side of things. The surge is really the greatest news inside of this presentation. The surge is about world growth really getting entrenched at the moment, and a lot of indicators, multiple indicators actually showing that we are back to fundamentally strong growth, and that we may have some weather aberrations here or there, but things are actually good. That ushers in another set of issues. If there's a surge in activity, and we're having a surge after 5 years of very challenged economic activity, and so getting ourselves out of the mindset of the slow years, the slow last 5 years that we've had, is going to be very tricky. And so there's some particulars that are coming into the world and the Canadian economy as a result of that. And finally, the solutions. So if the squeeze is actually causing problems, are there any solutions out there? And what do those solutions actually mean for the construction industry? Well, let's talk first about the surge. What does it actually mean out there? I'm going to show you a chart that I've actually shown you before. This is the chart of composite OECD leading indicators. That's a whole pile of indicators that are put together in one indicator, and they show what's going to happen inside of the OECD region over the next 6-month period of time. And I'm happy to report to you that right across that 50% of world GDP, now for the first time in the post-stimulus period, we have 13 months of successive increases in this indicator. Well, if that's what we're talking about right across the OECD, and I'm really talking about the end of the chart here, right at the end we see that there are 16, the last shaded area there, there are those 13 months of uninterrupted growth in this indicator. If you look closely, right at the end of the series, they are actually accelerating. Well, that's some of the greatest news that we have seen over the last little while. So the leading indicators are certainly pointing upward. One of my favorite leading indicators, and very relevant for the construction and forestry sectors inside of Canada, is the U.S. housing market. So I keep going back to this one because it has been so instructive for us over this business cycle. You can see the ups and downs of the U.S. cycle, and it's plain inside of this chart that the U.S. housing market has been down for an awfully long period of time and hasn't started pointing up until the last 18 months. But now it's rising at somewhere between 20 and 30% year over year and continuing to rise. The good news is not only is this a leading indicator of activity, but it's showing us how much pent-up demand there is in the U.S. economy. If you look prior to the crisis, that area above the green line, which is demographic requirements inside of the U.S. market, is a region of pure excess. But now we see that the underbuild that has happened for all of these years, that area under the curve is actually greater now than the area above the curve. That means there's pent-up demand inside of the economy. So we look at other indicators like the amount of inventory in the U.S. market at the moment. It peaked at double-digit rates a number of years ago. Now we have a situation where that number is at about 4.5 months. It doesn't get much lower than that. So here we are. The numbers on a monthly basis might be volatile. I believe a lot of that is due to weather. The fundamental inventory situation inside of the economy is, or inside of the housing market, is very, very tight. and prices are still rising at a double-digit year-over-year rate. So things still very strong inside of that very key market in the United States. So we're still looking at that and saying, okay, it's telling us one thing. It's a leading indicator that's pointing upward in the biggest economy in the world, but it's also saying, hey, there's pent-up demand here. There's still going to be a lot of growth coming out of this. So we expect another 40 to 50% increase in this just to get it to the point of being sustainable. Excuse me. Okay, so that's the housing market. We've talked about that before. It's still on the up and up. We're still feeling very good about it. So point number one, the leading indicators are up. Point number two, we have pent-up demand inside of the economy. Point number three is the appearance of something that I wasn't able to talk about with you last year. In the middle of 2013, something amazing happened in the global economy. It's something that hasn't been around for the last 5 years, especially in the United States economy, and that is confidence. I've talked to you about confidence before, and we've been waiting for that indicator to come back. Well, last March when I was with you, we could not say that that indicator was back by any stretch of the imagination. We were waiting for it to come back. We were wondering if it would come back, but now we are actually seeing that happen. Look, this is a very long series here, so it doesn't look like much is happening towards the end of the chart. But look to the end of the chart there, and it shows you a 6-month period of time where we actually have confidence that has risen for the first time in 5 years. Confidence has risen above the recessionary level where it has been bound in the United States. Now, it's very unusual for Americans to stay down in that recessionary zone. Look at the past recessionary periods of time. They're in the zone, they're out of the zone, they can't figure out really where to reside. This time around, they were buried in the zone for that whole period of time. Now they have come out. And what I love about this is, and what is really important about this is, they came out all on their own. In fact, they came out in spite of the fact that the government was actually standing in the way of them coming out. You remember the fiscal cliff at the beginning of last year, the sequestration that the U.S. was going through right at the time that we were actually speaking with each other last March, and then, of course, the shutdown in October. Now, the shutdown in October did actually cause confidence to drop, but it's come right back up again. It's come right back up beyond the recessionary zone, significantly beyond that zone. So what's that telling us? The leading indicators are up. Pent-up demand is there, so people have to get out there and spend. But this revival of confidence is telling us that they want to get out there and spend. It's not a question of having to spend. They're actually eagerly out there spending again. And in America, it's not unsustainable spending. They've risen their savings rate. Their debt-to-income ratio is actually coming down. So the increase that we are seeing in real retail sales in the United States is perfectly sustainable. It's not coming on the reignition of another debt mountain inside of the United States. So very, very strong. Okay, is the U.S. the only place where confidence is rising? Look at what's happening in Western Europe. A really good revival, both in the business and consumer side of things in confidence. This chart is actually a little dated. That number has continued to rise in the last few months. So it's even better than it was inside of this chart. In Japan, the Tankan index is as high as it has been throughout this crisis period of time. So if even in Japan this index can be rising, then you add together those economies, the three economies are the economies of the EU, the economy of the United States, the economy of Japan, you're getting pretty close to about 45% of world GDP. And if they're feeling more confident on both the consumer and the business side of things, the world has turned a corner and we're ready for growth. Well, is that the only thing that's really happening inside of the economy? Look at GDP inside of the United States. It's bigger than just one segment of the economy. So there's been quite a revival. Those numbers in green are not a forecast number. Those are actuals. But I've highlighted them in green because that is self-sustaining growth that is happening in the United States. It's not as a result of policy. It's an acceleration that is happening all on its own. So we're really happy to see that happening inside of that economy. The other piece of good news is that the European economy is through its recession. So we have 2 and soon to be a 3rd quarter of revival inside of Europe. And what that is actually doing for the European economy at the moment is igniting that confidence, giving them a sense that all is not lost, that these fiscal and financial troubles that they've been having for years have not buried them forever. They are actually in growth mode at the moment. So we're even seeing places like Spain where growth is picking up quite remarkably at the moment. In fact, some of the fastest growth is happening in some of the most stretched economies, the ones that have had the worst fiscal problems. Okay, so GDP is up. It's showing us that economies are actually on the mend. What are some of the other reasons that are underpinning this growth around the world? Well, you see the three reasons up there. A fourth reason is actually we're getting a bit of a fiscal dividend. From what? The end of austerity. I've been telling you for years that the fiscal side, government spending and taxation, has actually been taking significant amounts of money off the table, and so it's been suppressing underlying growth. Well, last year that underlying growth was actually quite remarkably strong. So the fact that they're not cutting anymore means that that underlying rate of growth is all of a sudden revealed. Well, that underlying rate of growth, according to our estimates in the United States last year, was not 1.7%, which is what is being published on the GDP numbers. It was actually 3.7%. So it's a much stronger growth dynamic, and now we're going to see it in numbers because of the end of this government austerity. Well, that's going to have people feeling a whole lot better about themselves, and so as 2014 carries on, we're going to see this strong growth actually been revealed in the bottom line numbers. We're happy about that. Another element here is that, we would not be talking about tapering or the end of quantitative easing. Nobody would be talking about that if it wasn't for growth. It's actually growth that's initiating that. So the fact that the Fed in the US is zealously trying to taper back these purchases. So they've gone from 85 billion to 75 billion to 65 billion, and they're taking 10 billion off every time they get to a new phase. They're doing this regularly, and so markets are pricing that in. Well, they wouldn't be doing this if they didn't think the economy was strong enough to actually withstand that tapering activity. So the economy is firing on its own, and the Federal Reserve Board is telling us they are actually feeling much more confident about the state of growth than they have for a long, long period of time. Another one is a little bit more ethereal. It's the chatter factor. Through the crisis years, the media was making lots of money, getting people sort of apoplectic, really, about the next cliff that we were going to fall over. And that has sort of stopped. In the last 6 to 8 months, the media has shifted over from talking about and speculating about the next cliff to talking about growth. And that's actually helping in the public discourse. It's helping people to feel better about things, and it's actually quite coincident with the revival in consumer confidence. The final thing I would say is that in my community, there's much more of a consensus around the fact that world growth is actually building. I don't put a lot of faith in consensus. We've been counter-consensus for a number of years, but that consensus is actually coming around to a view of sustainable and higher world growth. Well, these are the reasons that we feel the recovery is actually a reality, and that 2014 is going to be the first year of the next business cycle, the next growth phase of the world economy. Okay, so if growth is actually there, can we just go back home and say, okay, well, if growth is back, we'll just go back to making money like we did before? Are there any difficulties with this growth as we go forward? Well, as you see, here is our growth forecast. The numbers are all there. You can see that the U.S. economy is leading the charge. We actually believe that in 2015, the American economy is going to grow closer to 4%. So this acceleration is going to carry forward into 2015. So it's something that builds this year and actually gains momentum next year. That's driving growth in industrialized markets. Industrialized markets this year will actually lead the charge. And that's what's going to enable emerging markets to get back on their feet again. So you can see the acceleration in emerging markets. That's actually going to grow next year. And of course, that's taking the world from a 3% growth path last year to a 4% path this year and to higher things in 2015. Well, that's a great news story. Here we have the world economy actually building momentum and significantly departing from the lethargic pace that we have seen over the last number of years. So how's Canada going to do? Can we just sit back on our laurels and say, well, Canada's been doing everything right, and so a revival in the world economy is only going to be positive for us? Well, consider that we Canadians, have been raising our debt burdens to keep the economy going over the last number of years. So our debt-to-income levels are sort of up at the levels that American debt-to-income levels were at prior to the crisis happening. Now, we don't think that we're looking a crisis in the face. We actually believe that this means that we're not going to get a whole lot of growth out of the consumer. There are other things going on in the Canadian economy, but this isn't going to be the source of growth. Neither is the housing market. And that may be bad news to you folks, but we just don't expect that in terms of multi-unit construction or singles, excuse me, over the next little while, there's a whole lot of growth potential for Canada, because according to this chart and according to our analysis, we've been overbuilding in Canada. You see the area above the curve for Canada. Well, that's where housing starts have resided over the last number of years, and it's a bit on the high side there. And so we're not expecting a full-blown correction, just like consumer spending. Other aspects of the economy will actually be in place to keep the housing market from imploding, but it's not going to be a source of growth. Neither is the government sector. So those are pretty big chunks of the overall economy. You're talking about somewhere between 60 and 70% of Canada's economy not really being a source of growth. So where then is the growth going to come from? Well, if the world economy is firing up, we actually believe that the trade side is going to contribute a fair amount. And this is where we come to talking about the Canadian dollar. Well, I'm hoping you remember over the last 2-3 years that this is exactly what we've been saying is going to happen with the Canadian dollar. So it has been softening. It's come down quite a bit from parity. It's sitting around 89 to 91 cents US at the moment. It's floating in that range. And that's a whole lot less than what we were talking about last March. So we gave you the logic behind why we thought the dollar was going to drift downward. It's actually gone lower than we told you that it was going to go. Well, why is it doing that? Oil prices have been quite weak, and particularly Canadian prices. So if you look at the price of Western Canadian Select, sometimes it's been selling at a 20 to a 40% discount over WTI. And WTI hasn't exactly been highly priced either. We're seeing some upward movement in that, but it's really weather related at the moment, and that's going to go away as we head into the spring and summer months. So this is still something that is downdrafting our currency. The rest of commodities, particularly the base metals, they have been coming down as well, and so we're not seeing a whole lot of upward movement from that side. And we fully expect that weakness will continue for the next 2 to 3 years. So again, this is another element that's actually drawing the currency down. Thirdly, the way that messaging is coming out of the Bank of Canada at the moment, it certainly looks like there's much more worry about disinflation in Canada than there is about reflation. And so for the time being, the messaging that we're getting at the moment is, well, the Fed may be doing its tapering, but the messaging isn't telling us that anything is imminently going to happen in Canada, and it's certainly at least going to happen in lockstep with what happens in the United States. So again, no upward movement in the currency coming from this particular indicator. Fourthly, we have the US dollar and how it's acting against most other currencies out there, and generally what we are seeing is modest appreciation. So we're on the back end of that. Canada's actually weakening as a result of that. Finally, Canada's halo is fading. We were the place to be in the post-crisis period. Everybody loved our resources, they loved our fiscal policy management, they loved our banking sector, they loved the fact that we had a domestic economy that seemed to be firing on all cylinders. I mean, all of those attributes actually brought a lot of interest and a lot of money to Canada. That's actually fading now, so that's another source of weakness of the Canadian currency. So we're not expecting it to stay in the 89-cent range for a protracted period of time. We actually see the dollar finding its footing somewhere between 92 and 93 cents. So that's how we're forecasting it going forward. What does this do, though, for the Canadian international trade sector? Well, it actually helps to give it added competitiveness at a time when the world economy is firing up. So we believe that this is going to be an aspect of the Canadian economy that actually gets a fair amount of lift. So globally, are there any difficulties that are going to be caused by growth? Well, very quickly, I believe I've gone through this chart with you before, but when the crisis happened, there was a ton of money in the economy from these three sources. And this money didn't have anywhere to go. People weren't borrowing, companies weren't borrowing, so what happened? The CFOs of the world pushed this money out into the market into successively riskier shells of investment. And that money ultimately found its way into global stock markets, particularly emerging market stock markets. It found itself in carry trade currency plays. Thirdly, it found itself in bonds, particularly risky, high-yielding bonds, and finally in commodities. And so that's what quantitative easing really helped to do for us. It mispriced assets as far as we could see. So commodities is the fourth element there. What's happening now that growth is back? Well, this money is actually making its way back through to regular activity in the economy. And it may make its way through the financial system, or it may decide to leapfrog over it. But what it's doing is it's suppressing stock market activity, believe it or not. It's causing currency volatility, particularly in emerging markets. It's causing raising capital inside of markets, particularly emerging markets, to be quite constrained. And finally, it's causing this phenomenon of weaker commodity prices just when the world economy is getting back on its feet. And that doesn't usually happen. Usually it's the other way around. So that's what we're faced with. What does that actually mean for us? Well, it means that there are going to be some emerging markets that are quite constrained in terms of their risk exposure to this. And this is a chart that we have worked up here to talk about the riskier emerging markets. And I just leave that in there for your reference. You can look at it later on. What are the implications of this, though? If you are looking at doing construction activity in other countries, there are a number of implications that you need to be aware of now. The increase in growth is going to be accompanied with a credit tightening. Now that's difficult because there are a lot of economies that are going to want to build out everything from institutional buildings to commercial buildings to industrial sector buildings and even residential sectors. But they're going to have difficulty raising money for those longer term projects. And so that credit tightening is something that we need to be aware of. One of the trends that's out there is long tenors are less favorable. And this has to do with the reconstruction of the global banking system. You know, bringing in Basel III and Dodd-Frank legislation and domestic regulations are actually constraining the amount of capital that is available out there. And European institutions in particular are looking at long tenor deals as unfavorable. Well, that hits certain sectors right between the eyes. And so when it comes to lining up capital, that's going to be difficult. There's certainly going to be less credit for emerging markets, as I've already mentioned. If you have cash, it could be a great opportunity for you. Now, you may not have the cash, you may not be able to underwrite things yourself, but strong financial institutions are key inside of here because the capital vacuum that is being created can actually be occupied by strong financial institutions. And guess what country in the world has strong financial institutions? You got it, Canada. Canada has strong public and private financial institutions and can work together with other countries that have similarly strong institutions to fill some of this vacuum. So you may not be able to get a contract just on your product alone, but if you have a financing solution that you can bring along with it, then that may be what seals the deal in the economy that we are facing over the next few years. So keep that in mind, and certainly keep EDC in mind if you're interested along those lines. There are likely as well to be more institutional players in the market space, so pension funds, insurance funds and so forth, operating more in the construction and infrastructure space globally. That may well be the case in Canada. I know that some of you are competing with others that are coming in with their capital and actually doing P3 deals in Canada. Well, that is a phenomenon that we're actually going to see more of, and it's not a bad idea to actually strategically look at the possibility of working together with these institutional funds. And as I've said, you know, given the strength of our institutions, there absolutely is a role for Canada. Whether you sole source something or go with a consortium, there is an aspect to waving the Canadian flag at the moment that could be very strong for gaining contracts around the world and even for gaining contracts inside of Canada. What about our domestic situation? What do we domestically face as we go forward? Well, one of our difficulties is we're really constrained by transportation infrastructure. And I wouldn't be surprised at all to see significant construction increases inside of the transportation sector, whether we're talking about roads, port facilities, particularly rail at the moment. And that's what this chart actually appeals to. What I've done is to illustrate both the United States and Canada, the share of railway car loadings that are being taken up by oil transportation at the moment. There is, with the interruption of the Keystone construction at the moment, and who knows when that is going to come on board, much rail activity is being devoted to actually moving oil around in tankers. Well, that's taking space away from other aspects of the economy that this rising world economy is actually going to demand. So we're already facing the difficulty of shipping bulk, whether it's agricultural or mining commodities, and the auto sector could run into trouble as well as a result of lack of availability of track capacity in cars and so forth. So what's the remedy? The remedy is construction, building out new transportation infrastructure, trying to accommodate all of this. On the transportation side of things, I fully expect that our energy sclerosis at the moment, this shut-in oil that we have in Canada, is going to bring pipeline projects as well. So again, more positives there for the Canadian construction sector as we go forward. I'm going to remind you again, labor constraints are going to get really tight. This is a chart of the population 15 to 54 years old, and 2016 is the magic year when this starts to go down. So if you need to lock in good, skilled workers, now is the time to do it. Love them or lose them. It's really important to make sure that you're aware of the constraints that exist in the Canadian economy. Even with a soft domestic sector, this is going to be a real challenge for us going forward. So we have the surge. The surge is growth. We have the squeeze factors there. We have solutions that are very appropriate to the construction sector. For the low amount of productive capacity we have, we believe that we could be in for a wave of business investment here in Canada. And you can see the other factors there. I've spoken about labor. I've spoken about infrastructure. It's important to keep our eyes on all of these things and to look for the opportunities inside of these sectors. One last thing I would like to say is, with the inking of the Comprehensive Economic and Trade Agreement with Europe, with the EU, we are now in a space where the construction industry is actually one of the top industries that has been identified as a net beneficiary. So I wanted to put this chart in front of you. It was a structural study that was actually done, and you can see that the construction industry is right up there in the top 5 industries in terms of benefits from the inking of the Canada-EU trade deal. So I just wanted to put that in front of you. More than happy to answer questions about that. What are our takeaways here? Global growth is definitely back. Domestic demand here in Canada is going to ease, so you won't see the construction opportunities on the domestic business investment front, investment that is focused on domestic demand inside of the Canadian market and together with the residential market here. But what you will see is that the export sector being reignited is actually going to cause we think, a wave of investment inside of export-oriented business investment. Fourthly, I've just said this, business investment boom, we put a question mark around that, but it's quite likely as we go forward. Infrastructure badly needed, so we have transportation infrastructure that we need to pay attention to. We expect to see the products happen there. And again, as I said to you before, labor, love them or lose them. So that brings me to the end of the presentation, and what we want to do is usher right into our Skype question and answer period. Thanks very much for your kind attention.